A very good morning, friends. So, welcome you all to the standard Ind AS 115. Well, I hope you have already taken the lectures on Ind AS 115. And today we're just going to have some quick recap in terms of the concepts of Ind AS 115. And of course, we're going to take some doubts also towards the end. You'll get the opportunity to raise your hands up and we'll be able to chat one to one. So I think let's begin the journey. So on the understanding that you've already taken the lectures on Ind AS 115, so what I'm going to do, going to basically make a walkthrough in terms of the major concepts of Ind AS 115. Of course, the standard is pretty long, and I can't make a walkthrough in terms of each and every complicated part of the standard, but I'll try to give a little more emphasis on the technical areas which are there in this Ind AS. So I think let's begin the journey. And let's first of all start with the name of the standard. Well, whenever I look at any particular standard, I'm always looking at, first of all, the name of the standard. And I try to look at, what is the meaning of every word in the standard. Ind AS 115 talks of revenue arising from, it says revenue arising from contracts with customers. So the name of the standard has got certain crucial words, and I think I'd like to draw your attention to certain words like revenue, contracts, as well as customer. So when I look at the name of the standard, it says revenue arising from contracts with customers. So the very first focus, what comes to the mind is revenue. Whenever I look at the word revenue, what comes to the mind is another terminology, and that is what we call income. So when I look at the word revenue, what comes to the mind is income, and immediately the question comes across, is revenue a larger term or is income a larger term? Which one is considered as wider in nature? Well, I would say, even if you look at the profit and loss statement under Schedule 3, you would see that we always say total income is revenue plus other income. So if you look at the Schedule 3 itself, it says total income is supposed to be, the total income is supposed to be revenue plus other income. So I think looking at this particular equation also, when I say revenue plus other income is supposed to be a total income, we can undoubtedly say that income is supposed to be a wider term. So what is the distinction between revenue and what is the meaning of income? Well, I would say anything which arises from the operation, a business operation, sale of goods, rendering of services, is supposed to be a revenue. And if you're getting anything which is other than a business operations, non-operations, a rental income, a interest and a dividend income, then I would say that it is all supposed to be other income. So the focus in terms of Ind AS 111, 115 is not based on income, but the focus is based on revenue. What arises from the business operations of the company? So are we looking at the recognition of revenue from the sale of goods and rendering of services? That's precisely correct. So I think one of the focus points, what is coming to the mind is when you're looking in terms of revenue, we are looking at revenue which arises from sale of goods, or we can say rendering of services. So any kind of revenue which is arising from sale of goods and rendering of services is what we can say is supposed to be revenue. But I would also like to clarify one small little thing, because sometimes that is a misconception. Let's say, for example, if you sell a property, plant, equipment, you're going to calculate the profit or loss as per Ind AS 16. Now, mind this carefully, this is very crucial information. If you're going to sell an asset, a PPE, the calculation of the profit or loss on sale is going to be based on Ind AS 16, but the timing factor for the recognition of that income certainly is guided by Ind AS 115. But I think we'll not get into those complications. We can simply say that when you're looking in terms of revenue, just keep in mind sale of goods, rendering of services. That's the focus point. When you look at the word revenue, we're not looking at income, we're looking at revenue. That's one. Second, the second term, as we can say that there is a contract. Now, I guess we all know that contract is supposed to be between two parties. A minimum of two parties are required for the purpose of the contract. So when you're looking at those two parties, I would say the two parties are, number one, I would say it is the reporting entity. And number two, I would say it is supposed to be the customer. So when you're looking at a recognition of revenue arising from a contract, naturally that contract is between the reporting entity on one hand and the customer on the other hand. The next question immediately what comes to the mind, which is also the focus word number three, that who is a customer? Well, I would put it in a very simple word. A customer is one who is going to pay you a consideration. So I would say the key element in terms of identifying the customer is one who pays consideration. Who pays a consideration to you is going to be called as a customer. So let's give you a very simple clarification at this end. Let's say, for example, I am acting as an agent to a particular entity. So there is a principal agency relationship. So let's say there is X Limited and there is Y Limited, and Y is acting as an agent to the principal X. Well, in this particular case, I would say the customer of Y is supposed to be the principal. The consideration, the commission which Y is going to get from X. So we would say the customer of the agent is going to be the principal. The ultimate consumer who's going to consume the goods is the customer of X. But when you look at that in an agency relationship, who is a customer of the agent, I would say the principal becomes the customer, because the principal is the one who pays the consideration. So I think I've given you three focus words just to get a little clarity in terms of what we are studying in this standard. So the moment you look at the name of the standard, there are three focus words which should come to your mind. One is in terms of revenue, and immediately your thought should be very clear that revenue means something which is arising from sale of goods, rendering of services, that is linked to business operation. Second, you're looking at the word contract. It means a contract between two parties, the reporting entity on one hand and the customer on the other. And the third aspect is the customer. The customer is the one who pays a consideration to the entity. That was the three inputs to begin with. Now, let's go further. When I look at this standard, it reminds me because our source of Indian accounting standard, of course, is IFRS. And you know that there are two major gaps in the world. One is IFRS and one is US GAAP. And there is principally a lot of difference in terms of US GAAP and in terms of IFRS. IFRS focuses more on principle-based accounting, and US GAAP focuses mainly in terms of a rule-based accounting. But interestingly, these two standard setting bodies, IFRS is made by, you can say, the body is IASB, International Accounting Standard Board. And as far as US GAAP is concerned, it is made by the body which is called FASB, Financial Accounting Standard Board. So they came together and they've created, a standard which is, you can say, a blend of the two thought processes of these. In US GAAP, it is called ASC 606. Like they call it as Accounting Standard Codification, just for your knowledge. And in terms of IFRS, we've got IFRS 15. So you can see a blend of a principle and a rule-based accounting, which is there in terms of IFRS 15, or we can say Ind AS 115. So because of this blend of the rule-based and the principle-based accounting, so what has happened in this particular case, we've created what we call a 5-step model. Because if you look at the US GAAPs, they're mainly created on a step-by-step approach. Well, that doesn't mean that they are completely rule-based standards, but they are largely rule-based standards. So once the two accounting standard bodies came together, they created something very wonderful indeed. And they created a blend of a rule-based and a principle-based standard. So to begin with, Ind AS 115, was created based on a simple five-step model. And what are the five steps? If I just quickly pen down the five steps which are there, and we'll make a walkthrough on each of these steps one by one. So the first step is that we're looking at identify the contract. The first step is that we identify the contract. Now, what does it mean that we're going to identify the contract? Why I always tell people that when you're looking at identification of the contract, you are trying to see that it is a valid contract. Here, the basic thought process is looking at that is it supposed to be a valid contract or not? Now, let me caution something. When I say it's a valid contract, it is not valid from the legal perspective. We're looking at the validity of the contract from the accounting perspective. So para number 9 of Ind AS 115 is given a certain parameters with the help of which we will be able to decide whether it is a valid contract from the accounting perspective. What are those, 5 essential elements which are given? We'll come to that slightly later. Once you met the step number 1, then we go on to the step number 2, and that is we need to identify what we call the performance obligations. And that's one very important input. And I think I generally feel that, people falter in terms of identifying performance obligation. Though I think in the exams, this has not been, too much on a focus point. But yes, I will teach you the art today. I'm going to put a little more stress in terms of explaining you how do we identify the performance obligation, because that's one of the core elements in terms of the 5-step. Because unless you're able to identify the performance obligations, we may not be able to identify, how the revenue recognition is going to take place. So even from the practical aspect point of view, the second step assumes a lot of critical importance. The third step is to determine what we call TP. The third step is what we call TP, that is a transaction price. In simple words, the consideration which the customer is going to pay us. But there are going to be a lot of variety of inputs which we need to understand on a transaction price. The consideration could be fixed. The consideration could be variable. There could be a interest element which is included in the consideration. The consideration may be non-cash in nature. So there are a couple of typical points which we need to understand as far as a transaction price is concerned. Because things would assume a little more complications when you look at the presence of a variable consideration. When you're looking at the presence of a significant financing component in the transaction price. So we'll discuss in detail the concept of what is a TP. And then it is step number 4, allocation of TP. It is allocation of TP to various performance obligations. Well, in step number 2, you've already identified the performance obligations. And in step number 3, you've got the TP. Now it's time that you divide, or you can say allocate the transaction price to the various performance obligations identified in step number 2. Because we will be able to recognize revenue for each and every performance obligation separately. So it is very important that the total consideration which you will get from the customer is supposed to be allocated, divided to various performance obligations. And finally, the step number 5 is on revenue recognition. The revenue recognition is working on the principle that either, it's basically deciding, I would say, the timing factor. It is basically deciding the timing factor for recognition of revenue. Do we recognize the revenue over a period of time that is using a percentage completion method? Or do we recognize a revenue based on, once the work is completely done, and that is called a completed contract method? So we need to take a call for each and every performance obligation. You need to consider that if there are 3 performance obligations, you need to determine that whether it is a PCM, a percentage completion for each one of them, is it a CCM, or maybe few performance obligations measured on CCM, few performance obligations measured on a PCM. So in short, we can say these are the 5 steps which are involved in terms of, recognition of revenue. Identify the contract is valid, determine the performance obligations, get the transaction price, allocate the TP to the various performance obligations, and then decide the timing factor for the recognition of revenue. So let's now do one thing. We are going to make a walkthrough on each and every step one by one. We'll try to recap the concepts of the crucial concepts involved under each of these steps. So let's begin the journey. So I'm going to start with, first of all, my step number 1. As I said, the step number 1 is to look at whether it's a valid contract. We call it as identifying the contract, but I always call this that it is a valid contract, and there is para number 9 of the standard. You need not remember the para number. That is just for ease of convenience. I'm telling you the para number. So technically speaking, when you're looking in terms of the valid contract, the standard says there are a total of 5 parameters. The standard has given us a total of 5 parameters. You need to meet all the 5 parameters. Even if any one of the parameter is not met, you cannot go to the step number 2. So in terms of step number 1, there are a total of 5 essential elements of a valid contract. All these 5 essential elements need to be met. Any one fails, you cannot go to the step number 2. So what is important is that we need to meet all the 5 parameters. All the 5 parameters have to be met. Otherwise, we cannot go on to the step number 2. So let's quickly understand what are the 5 essential elements in a contract. Number 1. The first thing is we need to see that the contract is approved. I'm using the crucial words. So we need to see, first of all, that the contract is approved. Well, when I say that the contract is approved, I would say that it is enforceable in the court of law. So when you say that the contract is approved, the 2 parties, the customer and the reporting entity, so the contract is approved by both of them, it is enforceable in the court of law. So is the contract supposed to be in writing to become it enforceable? Not necessarily so. Irrespective whether the contract is oral or irrespective it is supposed to be in written, in both the cases we can say that it is a valid contract. So it is not necessary that it has to be a written contract. So let me also tell you that when I say it is approved, it could be oral contract, it could be a written contract. That doesn't make any difference. That is one. The second condition which is put in is that we are able to identify the rights of both the parties. I'm not saying rights of the customer. I'm saying rights of both the parties. So we should be able to identify. We should be able to identify the rights of both parties. So I'm putting a circle. We should be able to identify the rights of both the parties. So we should be able to identify the rights of the customer as well as the reporting entity, both. So that is the key word. So when you read the contract, you should be able to identify the rights of the customer. You should be able to identify the rights of the reporting entity as well. Next, the payment terms should be clear. The payment terms must be clear. So we should be able to identify very clearly that, what is the payment term? What is the mode of payment? When is the payment going to be made? So all the parameters regarding the payment should be very clear. The timing factor of the payment, the mode of the payment. So all those things should be very clear. Next, it says the contract is got a commercial substance. The next is that the contract is got a commercial substance. Now, this is a very crucial term. In fact, you see this in many of these standards, like, if you look at Ind AS 16, to remind you, you would see this word commercial substance is used in terms of Ind AS 16 as well. So what does a commercial substance mean? A commercial substance means that because of this contract, there is going to be a change in terms of cash flow. In simple words, I would say that profit making objective has to be on the background. Because of this contract, I know that the cash flows of my entity is going to undergo a change. And I think generally, I would assume, yes, the contract has got a commercial substance, because if the entity is entering into the contract, there will definitely be a commercial objective. And if there is a commercial objective, then commercial substance will get met. And the fifth condition is that the collection is probable. And that's a very crucial condition. That the collection is supposed to be probable. When we say probable, it means it is more than a 50% chance that you're going to get your money. Does this mean that if you enter into a contract with a customer and the collection is not probable, I will not be able to recognize revenue? Yes, you will not be able to recognize revenue. One of the most crucial conditions of a contract being valid is you should be able to prove at the time when you enter the contract that there are more than 50% chances of the money getting collected from the customer. Well, if the probability of collection, goes bad at a later stage, that would be creating a provision for doubtful debts. But we're looking at the inception, that when the contract is entered into, the collection needs to be probable. So the moral of the story, if you are looking at Ind AS 115, there are a total of 5 conditions which need to be met. The step number 1, which is identifying the valid contract, you need to be careful that there are all 5 elements present, then only I can go to step number 2. So quickly to put them, you can say, number 1, we need to see the contract is approved. The rights of both the parties are identifiable. The payment terms are very clear, the commercial substance is present, and the collection is supposed to be probable. If all these conditions are there, you go to step 2. Any one condition fails, you cannot go to the step number 2. I think that's pretty simple and pretty straight indeed. Okay, let's go to the next phase. Now we go on to the step number 2. That was step 1. Now let's talk in terms of step number 2, which is very interesting, but slightly complicated as well. And that is identifying. And that is identifying what we call the performance obligations. This is where I find sometimes, students tend to get confused. And they're not able to really visualize, how do we get the performance obligation? So let me spend a little good time giving you the explanation on performance obligations. Well, first of all, let me tell you that there is a word we can say promises, and there is a word which we can say performance obligations. The word promise and the word performance obligations cannot be used interchangeably. You heard me correct. Many people believe that promise and performance obligations are same. They're not. So when you're looking at the word promise and a performance obligation, they are not the same. They are not the same. In a contract, you would notice that there might be multiple promises made by the reporting entity to the customer. So in technical words, we can say that sometimes we might be providing bundle of goods and services to the customer. We may be providing more than one good, or we may be providing more than one services bundled together to the customer. And the objective in terms of this step is what we call unbundle the contract. Since you've entered into the contract in which you've bundled everything together, now there is a need to unbundle the contract, because I would recognize revenue as and when each and every performance obligation is met. So the first thing what you need to understand is that there are promises in the contract and there are performance obligation. Now let me first tell you one thing. Let's say, for example, there are 3 promises in a contract. Let's say, for example, theoretically, there are 3 promises in the contract. Now, what does the step number 2 require? You need to evaluate whether every promise is a performance obligation. Mind the words carefully. You need to evaluate whether every promise is a performance obligation. So there is a possibility that I reach a conclusion that 3 promises are 3 performance obligations. I evaluated every promise, and every promise turned out to be a performance obligation. So three promises makes it three performance obligation. Or there is a possibility that all the three promises put together is a single performance obligation. So please keep in mind the word promise and performance obligations are different. So when you look at the promises in a contract, the possibility is that every promise becomes a PO, or all the promises clubbed together becomes a PO, or there is a possibility that three promises becomes two performance obligation. The two promises clubbed together as a single PO, and the third promise becomes a second performance obligation. So we need to learn the art in terms of step number 2. How do you evaluate whether a given promise is a performance obligation or not? And for this particular purpose, I'm going to give you some examples also, but let's first understand the thought process. So how do you identify that whether a given promise is a performance obligation or not? So we need to understand whether a given promise is supposed to be a performance obligation or not. So in this particular case, I would say there are two aspects. Now hear this very carefully. There are a total of two aspects which we need to understand. The standard makes it very clear that you need to see things from the entity's point of view, and you need to see things from the customer's point of view. In order to identify whether a given promise is a performance obligation, you need to apply both the perceptions. You need to think from the entity's perception, and you also need to think from the customer's perception as well. So in order to identify this, we will look at entity's point of view. We will look at things from the entity's point of view, and we will also look at from the customer's point of view. So we will look into the things from both the perceptions and then reach a final conclusion. So in order to identify whether a given promise is a performance obligation, look at the entity perception and look at the customer's perception. Now, there are certain simple questions which I need to put across in this case. Number one, if you're looking at from an entity's point of view, I will put a question to the entity. Let's say they are selling A, B, C, three products together. So let's say they entered into the contract with the customer where they're going to sell A plus B plus C as a bundle to a customer. I will put a question to the entity. Are you selling A, B, C separately as well? So do you sell A, B, or C separately as well? So the question what you need to put across to the entity is, are they selling each goods and service in the bundle separately? So you need to put across a question to the entity. Are you selling each and every goods or service in the bundle separately? You entered into the contract with the customer to sell A plus B plus C. So you're going to put across a question to them that in this particular case, are you selling A separately, B separately, and C separately? Now, why am I putting this question to the entity? I need to basically understand, does the entity have a separate market for each good and service? And if yes, that means if I give product A to the customer, he can get advantage. He doesn't need to wait for me to give him B and C as well. The presence of a separate market for each product within the bundle indicates that if I deliver A to the customer, he will be able to get a benefit. If I give him B, he will be able to get a benefit. He doesn't need to wait for me to give all three so that he can obtain benefit. So if the entity tells me that they are selling all these goods and services separately as well, they say, yes, they are selling it separately as well, I will immediately go to the customer's perception. So it's a very simple affair. You just need to ask a question to the entity and ask them that, if you're selling A plus B plus C to the customer, do you sell A separately? Do you sell B separately? Do you sell C separately to other customers? They say, yes, we've got a market. We sell A separately. We sell B and C separately. I'll say, okay, now let me check the customer's point of view. And in the customer's point of view, the question what I need to put across is, what does he want? What does the customer want? The perception out here is looking at what the customer wants. So you need to basically see, what does he want? When he entered into the contract, what does he want out of the contract will decide the fate. We'll come to that later. Now let's see the second combination. If the entity says no, we do not sell. We do not sell A, B, or C on a separate basis. Well, in that particular case, if you're not selling A, B, or C separately, in those particular cases, I would say it is a single performance obligation. You go to club ABC and it is going to be considered as one performance obligation. So let's put it again, a very simple affair. So when you look at a contract and the customer has entered into the contract where he wants to buy, let's say, 3 products, A plus B plus C. I'll ask a question to the entity. I'll tell the entity, do you sell A or B or C separately, independently to other customers as well? They say, no, we are always selling ABC as a bundle. We don't have customers who buy A separately or B or C separately. In that case, I am directly going to say it's a single performance obligation. I'll not even look at the customer's perception. But if the entity tells me that, yes, we are selling A and B and C on a separate basis as well, they've got a market where they are selling A or B or C separately to other customers as well, then it is important for me to look into the customer's perception as well. Now the question rises, what are we going to look at the customer's point of view? Now, in terms of the customer's point of view, I would like to give you 3 things. What I'm giving you, the 3 things, is not an exhaustive list. It is not an exhaustive list. It is purely an illustrative list in nature. So let's give you 3 inputs in this case. I'm looking at the customer's point of view. I'm looking at the customer's point of view. Now, please hear this very carefully. What I'm about to tell you is crucial. Don't worry, we'll take some examples as well. Now, when you're looking at a customer's point of view, if one of the 3 things is seen, mind the words carefully, if any one of the 3 things is seen, I would consider that to be a single performance obligation. So I'm giving you a list of 3 things. If any one of these 3 happen, if any one of these 3 happen, I will consider it to be a single performance obligation. Though this 3 is not an exhaustive list as per the standard. But I think considering the examination point of view, we can more or less consider that if any of these 3 things are going to happen, so if any of these 3 things happen, I will consider it is a single performance obligation. Either of the 3 happens, I will say it is a single performance obligation. 1, I identify that there is a significant integration. I identify that there is a significant integration which is required. The customer says, I have entered into the contract because I want the entity to integrate everything into one. For example, let's say you are looking at a construction of a house. Let's say a customer entered into the contract with the entity to build a house for them. Now, there are a couple of promises in terms of construction of a house. You need to do the construction, whitewashing, flooring, electric fittings, etc. The list is long. Now, if you ask the entity, do you have customers to whom only electrical fittings are done, or do you've got customers for whom you only do whitewashings, etc.? The entity might say a yes. They may have customers to whom only one kind of service is being provided. But let's look at the customer's point of view. What did he want? He said, my idea of approaching you is that you're going to integrate everything into one whole. So he says that I want that you integrate all the goods and services, and you're going to give me one final output, and that is you build a house to me. So if the perception of the customer in terms of the contract is that there is a significant integration, and mind you, we're using the word significant integration. So if you notice that there is going to be a significant integration of goods and services, in this particular case, we are going to combine everything. All the promises will be combined and it will be treated as a single performance obligation. That is one. Second, that is one. Second. The second example which is given in the standard is that there might be a significant modification. The word used is again significant modification. The word used is again significant modification. Here again, I'm focusing on the word significant modification. I'll give you an example. A customer approaches an entity and says, I want to buy a software. And the company tells him that we are also going to give you some updates on the software, which is very crucial to the performance of the software. So the entity is going to give the customer an software, and then there will be certain updates which are very critical to the performance of the software. Which means once the updates are given, it will significantly modify the software. So what would a customer demand from the reporting entity? He would say that if you've given me the software, is your job over? No. He would say that I wanted the updates as well because they are critical to the performance of the software. So if I know that when the second goods or services are provided, it would significantly modify the first goods and service, mind you. So as an entity, I know that the customer's perception is the moment I give him a second good or service, it might significantly modify the first good or service. In my example, the updates could significantly modify the software. In that particular case, I would consider all the promises put together as a single performance obligation. So you need to understand reading the contract that what is the customer's perception. Is he entered into the contract with the objective that he wants everything to be significantly integrated into one? Is he entered into the contract where he knows that when the company will provide subsequent goods and services, they would significantly modify the initial goods and services? Then treat all the performance obligations as one, all the promises as one PO. Then there is a third one. You meet any one of them, and we're going to treat this as a single performance obligation. Let's have a look at another one. And the third input which is given in the standard is that if we know in this particular case, let's say the customer is aware that there is going to be a lot of highly interdependence, interrelationship between goods and services. So the word used is highly interdependent. I'm focusing the word highly interdependent. Highly interdependent or interrelated. Highly interdependent or highly interrelated. Let's take an example to understand this. Let's say, for example, a customer approaches an entity and he says that I want you to design the manufacture of a tool. He says, I want to get a manufacturing of a tooling done. And at the same time, I want that you design the tool and then you manufacture the tool. I want the same person to design it, and I want the same person to, manufacture the tool as well. The customer's perception is that designing is very crucial to the manufacture of that particular tool. So he wants the same person to do both the jobs. Now, since the designing as well as the manufacture of the tool is highly interrelated, interdependent, we will consider both the promises as a single PO. So moral of the story, I'll just put this across back again in terms of the step number 2, because this is a very crucial step. So when you're looking at identifying the performance obligation, your perception needs to be very clear that you need to first evaluate things from the entity's point of view, and then you need to evaluate things from the customer's point of view. So we need to basically look into once from the point of view of the entity, and once we need to look at from the customer's point of view. You cannot draw a conclusion. You cannot draw a conclusion whether the promises are clubbed as a single PO or every promise is a separate PO unless you've seen both the perceptions together. So at the first instance, what do? We look at the entity's perception. From the entity's point of view, we're just going to put him a very simple question. The entity will be put across a very simple question. We will simply ask the entity that if you're selling, let's say, 3 goods as a bundle, A, B, C, I'll tell the entity, okay, do you have customers to whom only A or B or C is sold on a separate basis? And if they say, no, we don't sell anything which is unbundled. Everything is sold as a bundle. Then undoubtedly, all the promises will be a single PO itself. The journey is done. That's combination one. So I think the entity's perception is very simple to understand that as an entity, if they tell me that we do not sell anything on an unbundled basis, we are selling all the goods and services as a bundle to all the set of customers, then I'm going to consider all the promises as a single PO. But if the entity tells me, no, we are selling each and every goods and services on a separate basis, then I will go to the customer's perception. And if any one of the parameter is met, I would consider that there is a single PO. And what are the 3 parameters? Any one of the parameters is met. Though, let me again recall this, that this 3 list of parameters which I'm giving you is merely illustrative in nature. The standard doesn't say that it is an exhaustive list of parameters. So you need to see what does the customer wants. Is he wanting for a significant integration of goods and services? And he wants everything as one whole? Is he aware of the fact that, the second goods and services will significantly modify the other goods and services? Or he knows that the different goods and services are interrelated, interdependent on a high basis? If any of these inputs happens, it is going to be simply a case of a single PO. Leaving these 3, you could say it's going to be more than one PO. Let's do one thing. Let's, I think, create a small little example chart as well. Before we go to the step number 3, let's, I think, have a quick look at these examples carefully so that everything gets set in the mind. So I'm going to consider these examples. So we are going to look at the example, look at the entity's perception, look at the customer's perception, and we're going to decide on an overall basis, is there a single PO or is there a multiple performance obligation? So let's take the example. Let's look at the entity's perception. Let's look at the customer's perception. And let's see, the performance obligation is going to be one or multiple in nature. So I'm just going to quickly take those 3 examples and do the evaluation from the entity and the customer's perception both. Number 1, a customer enters into a contract to build a house. A customer entered into a contract with the entity to build a house. Now, how many promises might be there? Huge. If I'm planning to construct a house, then I would say there are a lot of promises. You need to do construction, you need to do whitewashing, you need to do carpentry, you need to do electrical fittings, etc. I put across a question to the entity, do you have a separate customer base who get only carpentering work done from you, or who get only electrical fittings done from you? So they say, yes, we've got a huge customer base. Some people get only carpentering, some people get only electrical fittings. So they are making sales on a separate basis. They say we are selling things separately. We are providing, different goods and services to different clients. So from the entity's point of view, I would say there are multiple performance obligations. From the entity's point of view, there are multiple performance obligations. They would consider that if I am able to fulfill a particular promise, the performance obligation is met. So from the entity's point of view, each promise will become a performance obligation. But then I will go on to the customer's perception. I ask the customer and he says that, my idea of entering the contract with the entity is that they significantly integrate everything into one house. So he is requiring a significant integration of various goods and services. He says, my objective is that I want one output as a whole. I want the entity to build a house for me. So integrate every goods and services into a single output that is a house. So from the point of view of the customer, we will say it is a single performance obligation. And as we say, customer is the king. So in this particular case, even though from the entity's point of view, it is multiple PO, but from the customer's point of view, it is a single PO. On an overall basis, we will say it is a single PO. That is one example where we fall under the concept of significant integration required with the customer. Let's see the second one. Let's say I sold a software to the customer and we also told him that we'll give you updates, which are critical updates. So the reporting entity tells the customer, we're going to sell the software to you, and we're also going to give you updates on the software, which is very critical to the performance of the updates of the software. Now let's look at the entity's perception. Apparently, if you ask me, there are a total of two promises in this case. One is that you're selling a software. The second is that you're providing an update. So I would say there are two promises. Now let's put a question to the entity. Would they have a customer base where they're selling only a software without updates? And they will also have customers whom both the software and the update is sold? I would say yes. Even if you tell a customer that these updates are very crucial and critical to the performance of the software, he may not like to buy them. Because if you tell the customer to pay extra money for these updates, he might feel that, I can still carry on with the software without these critical updates. It's okay. I don't want to shell out extra money for that. So the entity will definitely have both the kind of customers, one who wants the updates and two who don't want the update. So is the entity making a separate, they are separately also selling these items? Only software without updates and the software with updates? I would say yes. So in this case, I would say there are two performance obligations. The sale of the software, one, and the updates, there is two. But then I need to go to the customer's point of view and evaluate what is his perception. A customer who has paid for the updates knows that the moment the update is given, it will significantly modify the software. So he's aware that the updates will significantly modify the software. And if it will significantly modify the software, from his point of view, it becomes a single one performance obligation. And I think if you look at now both the factors, entity's perception is two and customer's perception is one. So overall conclusion is that there is one performance obligation. We fall under the second exception. The customer knows that he wants a significant modification is going to happen. So it is treated as a single PO. Let's take a third example. As I took the example earlier, let's say, for example, the customer wants designing of the tool and then the manufacture of the tool. So he wants that you design the tool and you also manufacture the tool for the customer. So in this particular case, the customer entered into the contract where he says, you design the tool to me. And then he says, you also, in this particular case, manufacture the tool as well. Now, if I look at the perception, if I look at the perception of the entity, I tell them, okay, do you get customers who come only for designing? They say yes. Do you got customers who come only for manufacture? Yes. Do you get customers who come for both the activities? They say yes. We've got different kind of customers. People come only for manufacture. People come only for designing. People come for both the activities. So we are doing things on a separate basis. And the moment they say that they're providing things on a separate basis, I would say there are two performance obligations. One is the manufacture of the tool and other is the designing the tool. So I would say the two promises are going to be two separate obligations from the entity's point of view. Now let's look at from the customer's point of view. He says, my idea of entering the contract with the customer, my idea of entering the contract with the customer is, in this particular case, that everything is highly interdependent. Everything is highly interdependent in this case. He says, I want the same person to design and the same person to manufacture. They're interrelated, interdependent activities. So from his point of view, it becomes a single performance obligation, and therefore the customer's perception will win. So are we indirectly trying to say that here the customer is the king? Yes. I think Ind AS 115 makes it very clear that ultimately the customer's perception is the king. In this particular case, I think I like to, draw a little more attention to this fact. So what is the basic crux in terms of the step number 2? If you say from an entity's point of view, there are multiple POs. So what will happen as every obligation is done? I'll start recognizing a revenue. But I think the customer's perception is very important to me, because if from a customer's point of view, there is a single PO, I will be able to recognize revenue only once work is done on that single PO or the work is entirely done. How would I allow a company to recognize a revenue unless and until the customer starts getting a benefit? Because in this particular case, if I only consider entities' perception, entities would say that I've done this job and let me recognize a revenue. But I think the customer's perception is going to be of high importance, because unless he is getting the benefit of the goods and services, unless his objective is getting met, we cannot allow companies to recognize a revenue in this case. So this standard brought into account one very simple perception. Let's not be biased. Let's not only consider entities' perception. Let's not consider only the customer's perception. Since it is a contract between the entity and the customer, let's have a look at both the perceptions. Let's look at what is the perception of the entity and what's the perception of the customer. But at the end of the day, the customer's perception is going to take more importance. Because my recognition of revenue is based on the services and the goods I supply to the customer. And unless he starts getting a benefit of the goods and service, my revenue recognition cannot be allowed to take place. So that was on step number 2, that is identifying performance obligations. Okay, now let's, I think, go further. Now I'm going to go to the third step with you. So let's have a look now on step number 3. The third step is something very crucial and I think very important from the examination point of view. That is determination of a TP, that's called a transaction price. So my third step is to determine the transaction price, that's what we call TP. The first thing what comes to the mind is when you're looking at a transaction price. Let's say, for example, I'm selling goods of 100 and charging an 18% GST. So what is my transaction price? Is the transaction price going to be 118 or is it going to be 100? It's going to be 100. Any amount of taxes which I am collecting on behalf of a third party, the government, is not a part of my revenue. So when you look at the transaction price, the first thing we need to consider that this is going to be excluding GST. Because as far as the GST is concerned, it's a third party collection. And if it is a third party collection, it cannot be considered as a part of my transaction price. So the standard is very clear, excluding GST, because this is a third party collection. You're collecting this money on behalf of the customer. It's a third party collection, so not a part of your TP. Now, some crucial inputs comes into account as far as this transaction price is concerned, and I would broadly divide my discussions into various sections. I would say the first thing what I need to understand is the concept of a variable consideration. We need to understand the concept of variable consideration. So we're going to spend some good time on this, because variable consideration is something which, generally we tend to, get a little confused on. The second element of discussion is significant financing component. Significant financing component. That's another very crucial point, and we're going to spend some good time on this. So we're going to spend time on these two matters a little more detail, because these are very crucial, and we've got examination questions in the past relating to variable considerations as well as significant financing element. The third is non-cash consideration. The third element is what we call non-cash consideration. And the fourth one is consideration payable. Consideration payable to customer. So these are the four aspects of discussion with reference to step number 3. So when you're looking at a transaction price, you need to be very clear on a total of 4 aspects of a transaction price. Number 1, the variable consideration. Number 2, significant financing component in the transaction price. Number 3, there is a non-cash consideration. And number 4, there is a consideration which is payable to the customer, not receivable, payable to the customer. As an entity, you are paying something to the customer. So let's begin a discussion with the first aspect, that is variable consideration. So let's focus on, first of all, the concept of variable consideration. Now, as far as variable consideration is concerned, I'll first give you a very simple trick in terms of deciding that is the consideration variable or not. Something which you may or may not receive from the customer. Hear this very carefully. Something which you may or may not receive from the customer. That's one. Number 2, something which you've already received from the customer, but you might have to return it back. I think let's pen this down. The first thing is we decide what is variable consideration, BC. So I would say there are 2 aspects in terms of variable consideration. Number 1, some amount, rather saying that some amount which may or may not, some amount which may or may not be received in future. Some amount which may or may not be received in the future from the customer. Let's say, for example, the customer tells me that if the construction is completed in time, I'm going to give you bonus. So the customer tells me that if the construction is completed on time, I'm going to give you bonus. Now, I don't know as an entity whether I will be able to complete things on time or not. So I may or may not get the bonus. So in this particular case, I would say it becomes a variable consideration, because I may or may not receive. So if there is a question mark, with reference to the collection of this amount, we may or may not be able to get this money. If I complete on time, I will get the bonus. If I don't complete on time, I will not get the bonus. So that means the amount could vary. The amount of consideration which you're going to get from the customer could vary. That's one. Second, something I've already received, some amount already received, some amount which is already received, but might be refunded back. But it might be refunded back. I think both these factors will make the consideration variable in nature. Let's take an example for the second one as well, that some amount you've already received, but it might be refunded back to the customer. Let's take an example. Let's say I tell the customer, you buy 1,000 units from me. I give him a slab system. I say that you buy 1,000 units from me. The price is 100 rupees a unit. You buy 1,001 units up to 2,000. The price is 90 rupees per unit. Now, initially, the customer bought, let's say, 800 units from me. So I charged him 100 rupees a unit. But later he buys another 400 units and he reaches the second slab. And now I am supposed to sell him at 90 rupees a unit. So I will have to refund 10 rupees per unit for the initial units he's already purchased. I received an excess amount at the inception, but then I might have to refund this money if he reaches the second slab. So giving a slab system of discount to the customer, telling him that if you're in the first slab, I'll charge you 100. You reach the second slab, I'll charge you 90. So you've already received an amount of 10 rupees extra, which might be refunded. If you ask me what is the fixed consideration, I would say it is 90. Because out of that 100, 90 rupees which you're getting is confirmed yours, but 10 rupee which you're getting might have to be refunded back to the customer once he reaches the second slab. So we can say 10 rupee becomes a variable consideration in that case. So trust me, the most easiest way of looking at the consideration is variable or not, just look at the two parameters and you will be able to decide is the consideration variable. If there is something which you may or may not receive in the future because it is based on ifs and buts. You fulfill the conditions, you get the money. You don't fulfill the conditions, you don't get the money. So since it is based on ifs and buts, in this particular case, it makes it variable in nature. And the second is that you've already received something, but you might have to return it back. In those particular cases also, it becomes variable in nature. So the question arises that in terms of the transaction price, how would you treat this variable consideration? Well, I would say that once you reach a conclusion that it is a variable consideration, the second step is making an assessment. So I would say the second step is making an assessment. So your first step in terms of variable consideration would be to identify, is it variable in nature or not? And let me also tell you that there are various number of examples, but I think the most common out of variable consideration is bonus. And you can say any kind of incentives. Penalties, yes, it could be subjective. So I'll not talk much on penalties because penalties as per Ind AS 115 may be variable, may not be variable. And you can say any kind of discount policies, even a sale with a unlimited right to return could also make the consideration variable as well. You make a sale to the customer and you tell him that if you don't like the product, you can return it back. Even a sale with the right to return is going to be something which is variable in nature. So once you identify, yes, it is a variable consideration, the second crucial point is assessment. Now, what do you mean by assessment? You need to decide whether, in this case, you will get the bonus or not. In this case, you need to decide whether the customer will go to the second slab or not. So it is basically making an assessment whether an amount which you will receive or not. Make an assessment whether you receive it or not. If there is an amount you have already received, make an assessment. Will the customer reach the second slab or not? So assessment is going to be something very crucial in nature. And once the assessment is made, there is one very important parameter in terms of assessment. The standard uses a word, it should not result in significant reversal. It should not result in significant reversal of revenue. There's very crucial language which is given out here. They say that it should not result in a significant reversal of revenue. What do you mean by this? Let's have a little understanding. So let me just come out of this and explain you what do you mean by that there should not be a significant reversal. Let's take an example to understand what does the assessment in terms of significant reversal mean. Let's take a time scale. Let's consider this is year 1 and let's consider this is year 2. Let's say, for example, I entered into a contract with a customer where there is a fixed consideration of 10 lakh and there is going to be a bonus of 2 lakh rupees on early completion of the contract. I made an assessment and I said, yes, I will receive this 2 lakh rupee. So therefore, I decided that my transaction price is 12 lakh. I made an assessment that whether I am, reasonably certain that I will get this bonus amount. I made an assessment. Yes, I will get this bonus. And I took my TP as 12 lakh. Now, considering that my degree of completion for the work is, let's say 40%. So I applied a 40% degree of completion and I took a revenue of 4.8 lakhs in this case. Now, the standard also requires me to continuously do the assessment at each balance sheet date. Now, let's say on the second year, I decided that this 2 lakh rupees, the bonus is something which I will not get. I made a reassessment and I said, no. My assessment in the previous year was not correct. I feel now that I would not get this 2 lakh rupees. So my TP indirectly becomes 10 lakh. So let's consider the same degree of completion for convenience, though the work might have been progressed, but let's consider for convenience, same degree of completion. So you would have taken 4 lakhs as revenue. Indirectly, what has happened? The company is booked extra revenue in the last year. The company made an assessment that my TP is 12 lakh and they took a revenue of 4.8. In the second year, they said, no, TP is 10 lakh and they have taken a revenue of 4 lakh. So you have basically booked an excess revenue. You booked an excess revenue to the extent of 0.8 lakh and this will be reversed in year 2. The reversal of this revenue will take place in the year in which the reassessment takes place. And the standard is very clear that when you make an assessment, please ensure that it does not result in a significant reversal. It can result in a reversal, but it should not result in a significant reversal. The reason is that if I don't put this clause in the standard, what the companies will do, they will unnecessarily include the variable consideration as a part of TP. Inflate the revenues in a given year. And then suddenly in the next year, they will say, oh, my assessment went wrong. So they wanted to be very sure that the companies, when they make the assessment, they need to take this parameter that it should not result in any significant reversal. Your assessment should not be wrong. If you're saying that you will get this bonus, then it should not happen later that you say, no, my assessment was wrong. It can result in a reversal, but any kind of significant reversal in terms of revenue is something which will not be acceptable. So this is the parameter when we say that an assessment is to be done. If your assessment tells you you will get this money, take it as a part of TP. If your assessment tells you that this money will not be received, don't take it as a part of TP. And then comes the third stage, and that is reassessment. And that is called reassessment. The amount of variable consideration to be included or excluded from the TP is not a one-time assessment. You need to continuously, till the contract is not yet completed, you need to monitor the amount of variable consideration on year by year basis. Every reporting date, I'll sit down and make an assessment whether I'm still sure that this amount will be collected or not. Will I get this variable consideration or not? So reassessment is something which is very important. And I like to draw some attention more on the reassessment part, because this reassessment will lead to something what we call a cumulative catch-up adjustments as well. So let me just draw a little more attention to the concept of reassessment. So let's give you a little more insight on the concept of reassessment as well, that at each balance sheet date, when you're going to make the reassessment in this particular case, let's have a look further on this case. Now, when you're looking in terms of the reassessment, let's consider this is year one, and let's say this is year two. Well, we are saying that the assessment should not result in a significant reversal of revenue, but at the same time, let's understand this. So year one, and let's say year two. In year one, I included this in TP. I included the variable consideration in TP. And in year two, I decided, no, it's a mistake. We should not have taken this in TP, so we exclude it. Does the TP change? Yes, it does change. Because earlier you took it in TP, now you're saying, no, it should not have been taken in TP, so the TP changes. Because of this change in TP, can I say there will be a reversal of revenue? In this particular case, you included in TP, you took more revenue. Now you're saying, no, we should not have taken revenue. So there is a reversal of revenue. And this reversal in revenue will be recorded in year two. So this reversal of revenue will be taken care in year number two. I cannot do what we call a retrospective accounting. But let me also tell you something very interesting. This accounting can be technically called as a cumulative catch-up adjustment. Now, what is a cumulative catch-up adjustment? This is something which many people falter to understand. There are three kinds of accounting. One is called a retrospective accounting. One is called a prospective accounting. And one is called a cumulative catch-up adjustment. Now, please understand the distinction between these three. When I say retrospective accounting, it means you compute from the very inception and account it from the very inception. So when we do a retrospective accounting, we say, let's see that if this accounting was done from the very inception, so you compute it with retrospective effect and account it with a retrospective effect. When you say prospective accounting, you say, I'm going to change things from the date it changes. And then there is a cumulative catch-up adjustment, which means, hear the words carefully, you do a retrospective computation, but a prospective accounting. You heard me correct. When I say that there is a cumulative catch-up adjustment, it involves two things. A cumulative catch-up adjustments would mean that you are going to do retrospective computation. You will do retrospective computation. But there will be, you can say, prospective accounting. But there will be what we call a prospective accounting. So in this particular case, what I will do, I will say, okay, how much revenue did you take let's say you took a revenue of 5 lakhs. How much revenue you should have taken? I should have taken 4 lakhs. Retrospective calculation. With the new facts, see how much revenue you had already taken for the previous year, how much revenue you should have taken for the previous year, and you will account for this 1 lakh prospectively. You'll take the hit in the second year. So we will do a retrospective computation, assuming that if you would have done the accounting from the year 1 onwards, what would have been the impact? But the hit of that will be taken in the year 2 itself. This is one combination. There can be more combinations which can follow. Let's say, for example, you excluded, in the year 1, and now you said, no, my reassessment tells me that it should be included. Well, I think the same things will happen. The TP will undergo a change. And this time you will book an increase in revenue. Because earlier you took a lesser revenue because you excluded the variable consideration. Now you will book more revenue. So again, a cumulative catch-up adjustment would apply. So you took it in TP earlier. Now you say no. Or you did not take it in TP. Now you say yes. In both cases, TP will change and a retrospective computation with a prospective accounting called a cumulative catch-up adjustment would apply. Next. You said it should be excluded. Your reassessment still tells you that it should be excluded. Then there is no change in TP. I think that's fairly simple. In year 1 also you said we will not get this amount. Year 2 also we said we'll not get this amount. So your assessment, reassessment doesn't change the status. So there is no change in TP. No accountings would be done. Next. You said, and this is all the permutation combinations. The next is you said included in TP, and next year also included in TP. I know what you're thinking. You would say, okay, there's going to be no change in TP now. No, not necessarily so. In this case, the TP might undergo a change, and for the reason the variable consideration is measured, as you're aware, using a most likely or an expected value technique. When you consider whether variable consideration will be included in TP, you will consider either MLO, most likely outcome, or expected value method in terms of considering that variable consideration in TP. So even if you say it is included, there is a possibility that the method or the percentage of probabilities might have undergone a change. So I would say TP may change. I'm not saying that it will not change, it may change. So I think let's consolidate this learnings out here, what we have learned in terms of variable consideration. I'm just trying to give you quick recaps on the conceptual bit, because as you know, the standard is pretty long, but you've already watched these classes, and we're just trying to take a quick recap, and then we'll also take doubts towards the end. So I'm just going to now quickly take a recap in terms of the variable consideration, the first element in terms of my step number 3. Now, what we've understood is that in terms of variable consideration, I am going with a simple 3-step model. The first thing is you need to make an assessment that the consideration is variable in nature. And how do you decide that the consideration is variable in nature? Simple. I would say there are 2 parameters. One is you make an assessment, something which you may or may not receive in the future, or something which you've already received, but you might have to pay it back to the customer. So a consideration becomes variable when you know something in the future is based on ifs and buts, or something which you've already received, like I gave you a discount example. In those cases, the consideration becomes variable, which means your TP may be more or less because you may or may not receive, or you have already received, you might have to give it back. The second important fact is making an assessment, and the standard was very clear on the picture that, your assessment could tell you that, yes, I will receive this TP. I'll receive this variable consideration. But in any way, you need to ensure that if you're taking a variable consideration as a part of TP, it should not result in a significant reversal of revenue. Because today, if you take it in TP and tomorrow you say, no, it's not a part of TP, your revenue recognition would have already got inflated in the previous year. So it should not result that you later on say, no, 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 not a part of TP. And in this particular case, you stand reversing revenues, and that also at significant levels. Not acceptable. And as I said, the third step is that this assessment of variable consideration is not a one-time assessment. It's a continuous reassessment at each reporting date. The company will have to consciously keep making a reassessment, and you will have to basically consider that it was taken in 1 year, then you say no, not to be taken, TP changes. Or it was not taken, you say now to be taken, TP changes. Excluded both years, TP doesn't change. Or it is taken in 1 year, taken in the other year, but due to changes in probabilities in terms of calculating this TP, the TP might undergo a change. So what you need to do in all these cases when TP changes, you will have to do what we call a cumulative catch-up adjustment. Do a retrospective computation. Had the new facts known to you, how much revenue would you have taken in the past? Any increase or decrease in revenue is going to be accounted on a prospective manner in the year in which TP undergoes a change. So retrospective computation with a prospective accounting, that's called a cumulative catch-up adjustment. This is one aspect. Now let's come back to the chain of thought. So I've given you the inputs on variable consideration. Now I think let's discuss about the significant financing component as well. Or maybe I think we can first discuss the two smaller issues. Then I think we can come to the significant financing component after that, because that's going to take a little time. So I think let's first discuss these. Then I think we can probably give you a break after that. So it'll take me around 10-15 minutes. And then I think we can discuss that significant part later. So let's I think go to the non-cash consideration. Okay, now I'm coming to the next aspect, and that is non-cash consideration. Now here there is something very interesting which I like to give you. Well, I think if somebody were to ask me in simple words, how do you account for a non-cash consideration as a part of TP? I would say do one thing. You just consider the fair value. You just consider the fair value of what is received. So let's say, for example, a reporting entity gets equity shares from the customer. The customer says that I will give you equity shares in my company. So what will I do? I will consider the fair value of those particular shares as a part of the transaction price. And there is something interesting which we need to, be careful on. This especially with regard to the equity shares. So let's say, for example, the customer gives me equity shares in his company. So what will I do? I will take the fair value of the equity shares as a part of the TP. Would the fair value of these equity shares change over a period of time? Yes, it would. Am I supposed to accommodate the change in the fair value of equity shares as a part of my TP? The big answer is no. Let me just, I think, take you a little further, because in this connect, you would also you will also remind yourself in terms of Ind AS 109. Sir, Ind AS 109, suddenly, okay, I'll tell you. When you receive equity shares as an entity, it becomes an investment for you, because I'm the recipient. The customer is giving me equity shares, so I am indirectly a recipient. So in this particular case, the moment I get these equity share, it becomes an investment for me. And we know, as per Ind AS 109, financial instruments, that investment in equity shares is always taken at a fair value. I'm not talking of related party investments. I'm talking of unrelated party investments, because in any case, 109 does not apply to equity investments in related party. So when you're looking in terms of equity investments, they are always measured at a fair value. So any fair value changes are incorporated. Either it is FPTPL or it is FPT-OCI, whatever you choose as per 109. So let me make it very clear that if you're going to get equity shares, we will consider in the TP the fair value on the date of transaction. We will consider the fair value on the date of transaction. No update, I would say, rather, let's put it like this. I will update the fair value of this in equity shares, but not take it as a part of TP. It will be accounted under 109. So we can say any changes in fair value will not change, it will not change TP. So any changes in the fair value will not change the TP, but it will be accounted as per 109. It will be accounted as per Ind AS 109. There is a particular illustration also in the study material. If you go through, and you will see that there is, an inputs which is given on one of the examples where the share fair value changes. So I will not make any changes to the transaction price because of any changes in the fair value of this equity share. We will only account for this fair value changes as per 109, not under 115. So we just need to consider the fair value as on the date of transaction. Simple. This is non-cash consideration. The next one is consideration. The next one is consideration payable to customer. The next one is consideration which is payable to customer. Now, what we wonder is consideration payable to customer. So I'm going to give money to the customer. Yes, as an entity. Now, I'll give you very simple basic rules in terms of consideration payable to the customer. Now, there could be varied examples and we'll make a small chart on that. To incentivize a customer that he enters into a contract with me, I might compensate him. For example, there is a customer who's already dealing with another entity. And I tell him that you become my customer. He says, in order to exit from that contract, I need to pay penalty. So I said, don't worry, I'll pay you penalty for exiting out of that place. So there is a consideration which I am making a payment to the customer. So the question arises that if there is any kind of payment which I give to the customer, what should be the treatment of that consideration which I pay as an entity to the customer? So let's take another example before we build this concept. Let's say, for example, I have certain wholesalers with me. Let's say, for example, I am selling suitcases, and let's say I want to sell it in Reliance Bazaars. So I approach Reliance Bazaar and I tell them that I want to sell my suitcases. They say that, why don't you create a space for us? Why don't you create some showcases for us? And we will, put your suitcases on that showcases. I said, okay, I'll give you money to do the construction of the showcases. But at the end of the day, those showcases belongs to me. It's not your property. So I am giving a consideration to the customer to create those showcases, but then those showcases belongs to me. I will not give the rights of that, showcases to the customer. So I would say if there is a consideration payable to the customer, what we need to see is the entity getting something in return or not. If I pay a consideration to the customer, am I getting something, distinct goods and services in return? So the basic question what I need to put across, when there is a consideration which I give to the customer as an entity. So I will say, are we getting any distinct goods and services Are we getting any distinct goods or services in return? So we need to put across a question that as an entity, if I'm making a payment to the customer, am I getting any distinct goods and services in return? The answer could be a yes or a no. So if I say the answer is no, I'm not getting anything in return. Or the answer is yes, I am getting something in return. So for example, when I told the customer, you leave that other entity, become my customer, I'll pay you the penalty to exit out of the contract. Am I getting anything in return for paying the penalty payment? No. So in this particular case, if you are not getting anything in return, we will reduce TP. We will reduce the TP by the amount which you pay to the customer. Because it's like, one hand you receive money, one hand you pay money. So at the end of it, what are you getting is the net amount. So in this particular case, if I do not get anything in return, I will simply make a reduction in terms of transaction price. But if I am getting something in return, I would treat it as a separate transaction. Treat it as a separate transaction. I will treat this as a separate transaction altogether. So you can say that you are paying money to the customer. So indirectly now you become a customer of your customer. So like, for example, the example I said that I tell the customer, okay, you need to create some showcases and all, take this money, create the showcases, but it belongs to me. So I am indirectly getting something in return. So that's a separate transaction. Don't make any impacts on the TP. Your TP continues to be the same. So this is as far as a consideration payable to the customer is concerned. So let's go back. Let's go back on the chain. So I'll just like to quickly now take a recap. So the only input left over is one of the elements that is significant financing elements. Now let's, I think, consolidate the picture. In terms of step number 3, when you're looking at determination of a TP, the 4 agendas which could come into the mind is a variable consideration, significant financing component in the transaction, non-cash consideration, or a consideration which is payable to the customer. So if you're looking in terms of a variable consideration, it's going to be a simple 3-step model. First, decide, is it variable in nature? And I gave you the litmus test to decide whether it is variable or not. Step number 2, do an assessment. You need to be careful that if you are going to consider a variable consideration as a part of the TP, it should not result in a significant reversal at a later stage. And then step number 3, do a reassessment. And due to reassessment, if the TP undergoes a change, then there is a need to do a cumulative catch-up adjustment, retrospective computation with a prospective accounting. Consideration payable to the customer, the non-cash consideration, we will consider the fair value of what you receive. And if you receive equity shares, you are definitely going to account for the changes in fair value, but not as a part of the TP. It's going to be accounted as Ind AS 109. It's a separate investment for you as an entity, but that changes in the fair value will not result in any changes in the transaction price. And if there is a consideration payable to the customer, in this particular case, you need to consider that if you are getting something back in return, if you're getting something back in return, then in this particular case, it's a separate transaction. But otherwise, if you're not getting something back in return, it should be treated as a reduction in TP. Now comes the 4th and a very crucial point, that is significant financing component. Now, in this particular case, there are 2 important aspects. When you're looking at a significant financing component, one is, as a customer, he pays me advance, but I give him the goods later. Or as a customer, I deliver the goods to him today, but in this particular case, he pays later. So it could be an advance consideration. It could be a deferred consideration. So I think let's do one thing. Let's take a break at this stage. I'm sure you need one. Then I think we'll discuss this aspect of significant financing components in detail at that stage. So I think let's give you a 10-12 minutes break right now. So keep your mind relaxed, and I'm joining you in another 10 to 12 minutes time, and we'll start back with our discussion on step 3. Haji, thank you. Back, friends. So I hope you had a little mind rest as well. So we were talking in terms of step number three, and in step three, my focus is now on the significant financing component, which might be there in a transaction price. So let's, I think, discuss a little more detail as far as significant financing element is concerned. So I'm coming to the aspect of significant financing component. Significant financing component. Now, there is something very typical which we need to appreciate, that when we're looking at a significant financing component, I would say there are two cases. So when you look at this particular aspect, first look at which case are you looking at in the question. So I would say there are two cases. Case number one and case number two. The first case is, let's consider a time scale. Let's say a customer takes the control of goods, but he pays the money later. So I transfer the control of goods and service to the customer, but he pays the consideration at a later date. The second is, the customer makes an advance payment today, and the control of the goods and services, is given later. In simple words, I would say the case number one is a case of a DC, that is a deferred consideration, and the second case is a case of advance, where you receive the advance money from the customer. Now, what is most important is, you need to first of all identify the time gap between these two dates. In both the cases, the common element is that you need to look at the time gap. If the time gap is supposed to be 1 year or more, it could give rise to, mind the words, it could give rise to what we say a significant financing component. So I would again divide this in various stages, and I would say this is like step number one. So let's say this is like step number one. You first look at the time gap. You look at the time gap, that when the control is given and the customer pays, or when the advance is collected and the entity gives a control. If the time gap is 1 year or more than 1 year, there is a possibility that there might be a interest element included in the transaction. That is one. Second, even if the time gap is supposed to be 1 year or more, there could be a presence of financing element, but the standard is given a certain exceptions. And they say that even if the time gap is more, see you are falling under exceptions or not. If you're falling under exceptions, then the interest element will not be segregated. So there are a total of 3 exceptions which are given in the standard. So let's have a quick look at the 3 exceptions which are given in the standard. Number 1, if I receive advance from the customer and the discretion is given to the customer, how does he utilize the goods and services? The best example would be to look at, let's say, for example, you give a prepaid SIM card to the customer. So the customer pays you advance and you give a complete discretion to the customer. He can use that SIM card whenever he wants. So we can say that if there is a case of advance from the customer, but there is a complete discretion which is given to the customer. There is a complete discretion which is given to the customer. He is free to use that goods and services the way he wants. So in those particular cases, the interest element will not be segregated. That is one exception. Second, if your TPE is mainly variable in nature, If your transaction price is mainly variable in nature, for example, you might be collecting, let's say, a TP in the form of royalty, which is as a percentage of the sales. Now, since the sales are something which is not known as of now, it is going to be, determined at a later date. So if your consideration is mainly variable in nature, largely variable in nature, now what is mainly or largely is nowhere been defined in the standard. But if your transaction price is largely variable in nature, then we do not segregate the interest element, even though time gap is more than a year. And I think the most important element of the exception is, you can say, convenience. Or rather, I would not say convenience, I would rather say that it is more of trust issues. Let's put it like this, it is more of trust issues. I tell the customer I want money in advance because I don't trust him. I think he might not pay my money. My customer doesn't pay me advance money, he pays me later because he doesn't trust me. Because he feels that if I pay the money in advance, the entity will not perform the work. So there are trust issues. The trust issues could be at either of the ends. The reporting entity has got a trust issue on the customer. The customer has got some trust issues on the entity. So they have no reasons to enjoy any interest element. I'm not asking the customer to pay advance so that I get a benefit of financing. The customer is not making a delayed payment because he's got any interest of getting interest advantage, but he's got trust issues. So if the objective of delayed payment or if the objective of early collection is because of trust issues, the standard says we will not segregate the interest element. So at the first instance, when you look at the time gap, it is 1 year or more, you need to see that are you falling in the ambit of exceptions? If yes, the interest element will not be segregated. And if yes, you're not falling in exceptions, then we go to the third step and we go to look at the accounting in this case. So let's do one thing. Let's give you an accounting in terms of case 1 and 2 with journal entries to make the position very clear that how would you do an accounting in terms of journal entries. So let's have a look at the journal entries in these two cases. So let's take the case 1 and 2 and let's look at the journal entries in this case. So I'm looking at case 1, which is a case of DC. And I'm looking at the case number 2, which is a case of advance. Now, if the customer takes the control of goods and service, my revenue will definitely be recognized. So the day I transfer the control of the goods to the customer, I would recognize a revenue. So I would put the entry trade receivable gets a debit and the sales gets a credit at this stage. Now, let's say, for example, the customer is going to pay me, let's say, a total of 1,21,000 after 2 years. So he says, I'll pay you 1,21,000 after 2 years. So what I will do, I will take the present value of this amount. I will take a present value of this amount. So if he says, I'll pay you 1,21,000 after 2 years, let's say if the discounting is at 10%, I will recognize the revenue at the present value of the amount I will receive. So you will take a revenue to the extent of 1 lakh. And then what happens at the end of each year? So what I'll do at the end of year 1, you already know, and I think I'd like to reiterate that fact that in Ind AS, anytime you take a present value, it always leads to what we call unwinding of discount. It leads to the concept of calculating the interest element. So what I'll do in this case, since the customer is supposed to pay me money later, I will put the entry trade receivable debit and finance income gets a credit. I'll start unwinding the interest element which is there in this amount. So on this 1 lakh rupees, I take a 10% interest, that is 10,000. The same entry will be repeated in the second year, and now the amount of interest will be on 1,10,000, that is 11,000. So we will take the entry recognition of revenue and then unwinding of the interest element for the next 2 years. And then finally, when you receive the money from the customer, the entry is bank account gets a debit and the trade receivable gets a credit, and this will be to the extent of 1,21,000. So that's how the entries will look like. So when we're looking at the case of a deferred consideration, you're going to recognize a revenue on transfer of control. That's one. Then the unwinding of the finance income will take place for the 2 years or whatever the period is. And then finally, the collection of the money takes place. Let's look at the case if it is a case of advance. Now, if the customer pays me advance, I cannot recognize a revenue at this stage. If he gives me an advance, I can't recognize the revenue because I'm yet to give a control of the goods. So what I'll do, I'll put the entry that is bank account debit, and I will take the credit to a separate account that is, let's say, a contract liability. So let's say he gives me 1 lakh rupees of advance. So I'll take 1 lakh as the amount of advance which he gives me. So this entry is done with 1 lakh rupee. And then what I will do for the next 2 years, so the control is given after 2 years. So I'll put the entry at the year one end. Finance charge gets a debit and the contract liability gets a credit. And this is, let's say, 10%, 10,000. Here it is a case of DC, so you're taking a finance income. Here it is a case of advance, so you're treating it as a finance charge. Because when you're getting an advance from the customer, the entity is getting the benefit of financing, and that benefit of financing is being recorded in the form of finance charge in the books of accounts. Similarly, in the second year, you'll again repeat this entry, and now the interest will be 11. That is on 1,10,000, you take a 10% interest. And finally, when the control of the goods is transferred at the end of the second year, you'll put an entry at that stage. And that would be your contract liability will get a debit and the revenue is going to be given a credit at that stage. And this will be to the extent of 1,21,000. I think makes a perfect logical sense. So which means if I were to just, take a little consolidation of this view, I would say, just like variable consideration, it was a 3-step model. I would say even in terms of financing component, it's going to be again a 3-step model. And in terms of this 3-step model, what we're going to do, we're going to consider, first of all, we will see the time gap. Whether it's a case of advance or whether it's a case of deferred consideration, just look at the time gap. If the period between the two dates is 1 year or more than 1 year, there could be a possibility of a financing element. And then you need to see that you do not fall under the case of exceptions, where we said if you receive an advance from the customer and the discretion is with the customer, he can use the goods and services whenever he wants. Or if your TP is mainly variable in nature, or if you say that there are trust issues with the entity or customer, then we will not segregate the interest element. If you're not falling under the exceptions, then you will accordingly pass the entries, which I've given you separately with reference to DC as well as with reference to advance. So this is in nutshell as far as step number 3 is concerned with all the 4 issues with us. Now let's go to the step number 4. And step number 4 is quite mathematical because it is allocating the transaction price to the various performance obligations. So let's, I think, go to the step number 4. This is allocating transaction price to various performance obligation. Allocating the transaction price to various performance obligation. Now, I would say it's a very simple mathematical exercise, but at the same time, there could be 2 special issues which could arise when you allocate a TP to a various performance obligation. One is discount, and the other one is the concept of variable consideration. So let's give you some broader outlook that if there is a presence of a discount, how do you handle that? And if there is a variable consideration, how do you handle that? So first of all, I can say the allocation of TP will be in the ratio of standalone prices. The allocation of TP will be in the ratio of standalone prices. I'll allocate the transaction price to various performance obligations in the standalone price. So let's take an example. Let's say you've got three goods ABC. And let's say the standalone prices is, let's say, 2 lakh. And let's say it is 1 lakh. And let's say it is 1 lakh. And I'm intentionally taking the TP to be 4 lakh. Intentionally considering no discount at this stage. So what I will do, I will simply divide this 4 lakh rupees in the ratio of 2:1:1 between ABC. So if you say that ABC are three performance obligations, I will simply divide the TP in the ratio of standalone price, which is 2:1:1 in this given example. I guess fair enough, simple and straight. Now, as I said, there could be two special agendas which could arise in terms of allocation. One is a discount and one is a case of variable consideration. So let's have a look at these two cases. So let's have a look at the special issue with reference to this step. So I'm taking these special issues related to the step number 4. So one is a case of discount and one is a case of a VC, that is a variable consideration. Now, let's consider a very simple example to understand the concept of discount. Let's say the company is selling ABC and the transaction price is, let's say, 10 lakh. The standalone prices is, let's say, to the extent of 5 lakh, 4 lakh, and let's say 3 lakh. So if you add up the sum total of the standalone prices, it comes to 12 lakh. And the transaction price is 10 lakh. So visibly very clear that there is a discount to the extent of 2 lakh rupee. Your sum total of this is 12 and this is 10. So there is definitely a discount of 2. So what do I do? Shall I divide this 10 lakh rupees in the ratio of 5:4:3? Well, if there is nothing to the contrary, I would do that. If there is nothing which is contradiction, I would do that. Now let's consider the company is also selling A and B as a bundle. And we can see above that the standalone prices of A is 5 and B is 4 lakh. And let's say the transaction price in this particular case is, let's say, 7. So I came to know that the company sells A plus B plus C at a discount of 2. And I also came to know that the company is selling A plus B and that also at a discount of 2. I think anybody can reasonably identify that the company is giving a discount of 2 lakhs on both the bundle. Whether they're selling ABC, the discount is 2. Whether they're selling A and B, the discount is 2 lakh. So does this mean that there is no discount being given on C? Yes. Yes, it means that the company is not giving a discount on C, because in this particular case, if you are giving a discount of 2 lakhs on A and B and you're giving a discount of 2 lakhs on ABC, it is very clear that the company is not giving a discount on C. So how would you allocate the transaction price in this case? Pretty logical. If I were to allocate the transaction price, I would say out of this 10 lakh, you first allocate 3 lakh towards C. I will not allocate any element of discount towards C because there is no discount given on C. And then I will allocate towards A and B the remaining 7 lakhs. And this will be allocated in the ratio of 5:4. So we will divide the amount of, you can say, 7 lakhs, which is the remaining TP between A and B in the ratio of the transaction price, standalone prices 5:4. Makes sense. So this is one special issue which we can confront, that if there is a discount, you need to take a call. Is that discount relating to any particular performance obligations, maybe some of them, but not all of them? Or is it relating to all the performance obligation? That is one special care which we need to consider. Second, now let's consider the case of variable consideration. Let's say the company is selling two products, A and B. And in the agreement, they make a mention that A, there is a fixed consideration, which is 5 lakh, and B, there is a variable consideration that is 3 lakh. So in the contract, they specifically mention that there is a fixed consideration, which is relating to A, and there is a variable consideration, which is relating to B. Do we accept the contract? Do we accept what is the terms of the contract, or do we challenge them? We will definitely challenge them. You know, the spirit of Ind AS is that we are never going to accept the things on the face of it. We need to look at the substance of the transaction. So what I'll do, I'll take two examples. Let's consider in this case, I identify the standalone prices, and let's say the standalone prices is 5 lakh, and let's say the standalone prices is 3 lakh. Now, what I'm supposed to do, I'm supposed to compare the standalone prices with the terms in the agreement. And in this case, we don't see any contradiction between the standalone prices of A and B and what is stated in the agreement. So there is no reason that I would question the contract. So I would say, yes, what the contract states is correct. We will accept the fact that, yes, the fixed consideration is relating to A and the variable consideration is relating to B, because these prices stated in the contract is not in contradiction with these standalone prices. But let's consider another example. Let's say these standalone prices, in this case is, let's say 4 lakh, and this is also 4 lakh. If I accept the contract, it would mean overstatement of revenue for A. If I accept the contract, it would mean understatement of revenue for B, because the standalone prices do not match with what is stated in the contract. So will I accept the contract? No, I will not accept the contract. I will override the aspect and I will say that this entire 8 lakh relates to both A and B. I cannot say that fixed consideration only relates to A or variable consideration only relates to B. We will say 8 lakh relates to A and B combined. And we will allocate that in the ratio of standalone price. Which means in this particular case, what we're looking at is, do we accept the contract on the face, or do we challenge the terms and dig further? There could be a need to dig further. The moment we see that the things stated in the contract is in agreement with the standalone prices, there is nothing which can be suspected. But if you know that these standalone prices are not in consonance with what is stated in the agreement, there is a need to consider that, no, we are not accepting what is there in the contract. We'll see the larger picture. So I think these are the typical points which you are going to confront in terms of step number 4. One is the discount and one is the variable consideration. Rest, I think step number 4 is pretty simple and straight. Okay, now let's go further to the last step, that is step number 5. So I'm going to come to the step number 5, which is revenue recognition. Now, when I'm looking in terms of revenue recognition, there are two important aspects in this particular step. So let's have a look at what is the important aspect. The first thing what we need to take care is that when you're looking at recognition of revenue, the first thing you need to see is you need to apply what we call a control test. And let me compare this with what we call a risk and reward test. Ind AS has changed the position heavily in various standards, and the focus is on the control test and not a risk and reward test. So what is the difference between a control test and a risk and reward test? Number one, I would say the control test is much larger in magnitude. I would say the risk and reward is just one of the sub elements in terms of a control test. If you want to look at the larger picture, I would say the larger picture is in terms of the control test. Now, there are a lot of parameters which might be evaluated in terms of control test. Is the legal title given to the customer? Is the risk and reward with the customer? Has he been given the invoice which is accepted? Is the physical possession given to him? So there are a couple of factors. So the standard has given us a lot of factors which helps us to make an assessment whether the control of the goods and services is given to the customer or not. I don't think so. There has been any time in the exams where we've been asked to make evaluations of control tests because it can be very subjective indeed. Because as I said, there is not one, but there are multiple parameters which will decide whether the control of the goods and services is given to the customer. But one of the most important input is unless the control test is met, you cannot go to the revenue recognition stage. So you need to first of all prove that the control test passed. So once you say, yes, the control test has passed, then I will go to the next stage and I will decide on the timing factor of the revenue recognition. Now, if you look at the standard, I think typically para number 35 gives you an insight in terms of how the revenue recognition will take place in terms of this standard. And I would say basically the standard is giving us two focus points. I would say the standard has given us a total of two focus points. One is what we can say PCM and one is what we can say CCM. When I say PCM, it means a percentage completion method. And when I say a CCM, it is a completed contract method. In other words, the standard says revenue is recognized over a period of time or it is recognized at a point in time. So when I say it is recognized over a period of time, it is recognized over a period of time. Which means as and when the work is being done, we are going to recognize revenue. So it is called a percentage completion method. So we will see that, okay, as and when the work is being done, let's recognize revenue. The second is what they call as at a point in time. At a point in time. So when I say at a point in time, it means a completed contract method. That means until and unless the performance obligation is met, you will not be able to recognize revenue. So the standard is very clear on the picture that when you're looking at the timing factor for recognition of revenue, it is either a PCM or it is a CCM. How would we make an assessment that whether revenue is to be taken on a PCM or a CCM? Para number 35 has given us a total of 3 parameters. You must be wondering every time we're talking in terms of 3 parameters, variable consideration, 3 steps, significant financing component, 3 steps. I think it's a mere chance. So when you're looking in terms of para number 35, they tell you that there are 3 parameters. If any one is met, it is PCM. And if all fail, mind you, if all fail, then it is CCM. So let's have a look in terms of the 3 parameters which are given in para number 35. So let's look at those 3 parameters which are given as far as revenue recognition is concerned. Number 1, I'll take an examples also to explain that, but number 1. So I think let's draw this in the form of a chart. So there are a total of 3 parameters and you meet any one, it is PCM, you fail all, it is CCM. So I think let's put that down, that if you pass any one, it is supposed to be percentage completion. And if you fail all, then it is supposed to be completed contract method. So what is important is that you need to fail all of them. If you fail all of them, then only you can say that it is going to be a case of a completed contract method. Now let's have a look at, what are the 3 parameters which are given with reference to para 35. The first one is very simple. It says that as and when the entity is performing, the customer is getting simultaneous benefit. So what I need to prove that as and when I perform my obligations as an entity, is the customer getting a simultaneous benefit or not? So the key point is as entity performs. As the entity performs, customer is getting simultaneous advantage. Customer is getting a simultaneous advantage. Let's explain this with an example. So as and when the entity is performing, the customer is supposed to get simultaneous advantage. There is a very basic litmus test which I should apply to this particular clause. Ask a question to the entity. If the customer changes the entity, mind the words, if the customer changes the entity, passes on the work to somebody else, will he redo the entire work? Or will he start the work from where the previous entity left? So everything is dependent upon that if you appoint a new entity in place of the existing entity, is he going to re-perform everything or is he going to pick up the trail from where they left? So the question which you need to put across to yourself in this case is that if you appoint a new entity, will you have to rework? Will you have to rework the entire thing if you say yes or you say no? If you say you appoint a new entity and he will have to do the entire work all over again, in this particular case, the simultaneous advantage is not coming. This condition will fail. And if you say no, the condition will pass. Let's take an example. Let's say as an entity, I am providing payroll services to the client. If I'm providing payroll services to the client and if he appoints somebody else in my place, do you think the new entity will do the entire work all over again? Or is he going to pick up the trail from where I left? Naturally, he is going to pick up the trail from where I left. This proves the point that the customer is definitely getting a simultaneous advantage. But on the other hand, let's say, for example, I'm providing some specialized services like auditing services to the client. And if he appoints somebody else in my place, do you think the other party, the other person would redo the entire work? Yes, of course. He is not going to rely upon the work of the previous auditor and he will do the entire work. Therefore, the customer is not getting simultaneous advantage. To my mind, I think the first clause is more to do with the service industry. Though it is nowhere written in the standard, but I think it seems to be more a case of a service industry that if you're trying to say that as I perform, the customer is able to get benefit. So let's say you're providing laundry services, you're providing payroll services. I think it is quite implied that if they appoint somebody else in their place, the other person is not going to do the entire work all over again. So in this case, simultaneous advantage would come and a PCM would apply. Second, this is one, then there is second. So let's put or. Because you need to meet any one and you need to fail all for a CCM. The second one is that if your goods and services is in a WIP stage, you're still in WIP stage, but the control is with the customer. The control is with the customer. I think this would typically apply in terms of, I would say, asset construction. You know, what my mind tells me that if I'm looking at the clause number one, it's more to do with service industry. And when I'm looking at the second one, I think it's more to do with this really construction industry. Let's say, for example, as an entity, I am a builder and I'm doing a construction of a building on a piece of land which is owned by the customer. In that particular case, Even if the building is semi-complete, does the control of the building belongs to the customer? Yes. And I would say technically, it could depend upon whether it's a movable or immovable asset. Generally, I'm saying generally. If the construction is of movable assets, like for example, I'm constructing some machine for the customer, it is difficult to prove that the customer will get a control of that WIP. But if it is an immovable asset, like for example, building, then I think it is easy to prove that the control of the WIP definitely belongs to the customer. So if I'm able to prove that the control of the semi-complete item belongs to the customer, then I will be able to use a a PCM. Next. The next is that I am making certain tailor-made items for the customer. The standard says a language that you are creating some items which has got no alternative use for the entity, which in simple word means that I am creating certain tailor-made items for the customer. Something which is meant for him, I can't use it for other clients. And at the same time, we should be able to recover cost with reasonable profit margins. I should be able to recover cost with reasonable profit margins. So I am doing some work for the client which is supposed to be tailor-made. It is meant for a specific client, but at the same time, I know that I will be able to recover the cost which I've incurred and with a reasonable profit margin. If yes, I will be able to consider a percentage completion method. So what is important is that you need to meet any one of these conditions in order to recognize revenue on a percentage completion method. If all these conditions fails, you're saying that WIP control is not with the customer is not getting a simultaneous benefit. I am doing some tailor-made job for the customer, but I may not be able to recover the cost incurred with a profit margin, then the only point is a CCM. You will not be able to recognize revenue until and unless all the work gets done. This is the step number 5. So what I've done, I've basically given you a walkthrough in terms of the entire 5-step models to you. So now we've understood in nutshell, before I'll start taking questions from your side. So all we've understood is the step 1 is all about validity of the contract. The 5 essential elements in a contract. The second step is all looking into the fact that in this particular case, we're looking at the entity's perception and the customer's perception, and we're trying to come to a conclusion whether every promise is a separate PO or not, because that will decide the fate. Revenue recognition is going to be done for each performance obligation, CCM, PCM, as the case might be. Then step number 3 is looking at the various elements of a TP, the variable consideration, the significant financing component, the non-cash consideration, and the consideration payable to the customer. Then step number 4 is simply a mathematical exercise, allocating the, you can say the consideration, the TP to various obligations, but at the same time considering the special issues of discounts and the variable consideration. And finally, the step 5, where you first prove the control test and then you decide on the method for revenue recognition. I hope that all helps. So I think before we take it further, if you've got questions, I think now you can start raising hands and start putting questions to me. Yes, I think I've got a question. Yes. Yes, beta, please go ahead. Rakesh, is it right?
Good morning, sir. My name is Abrakesh.
Abhirkesh, good morning, beta.
I have few questions, sir.
Yeah,
Uh,
please.
Very first question is, what is the intention behind keeping the word with customers in the heading of the Ind AS 115? Contract is always with the customers, matlab, so why it needs to be specified?
Okay, that's a very good question indeed. So I'll take a little time to explain that because I think that's a very pertinent question. Not many people have asked me this question in the past. Now, you said, why is the word with customer given in the name of the standard? Is any contract with a customer going to fall under Ind AS 115? The answer is no. I'll give you a little example. Are you aware of Ind AS 116? I'm sure bit awareness might be there. Let me just take you to Ind AS 116. When two people enter into a lease contract, so one hand we've got lessor and one hand we've got lessee. At the first instance, we never call him as a lessor and we never call him as a lessee. If you start with the inputs of Ind AS 116, it talks of customer and it talks of entity. So it says that there is a contract between, rather not entity, they call it as supplier. So let me rather call it as supplier. So they say that there is a contract between a supplier and a customer. It is only after the parameters of Ind AS 116 is met and you classify this as a lease, he is called as a lessor and he is called as a lessee. So the idea is to emphasize, though we don't do it sometimes from the examination point of view, that when you look at a contract with a customer, not every contract is under the purview of this standard. So what you need to see, you need to first go to the scope of the standard. And then you need to see what is within the scope of the standard and what is not within the scope of the standard. So the word customer is being dealt with, that you go to the scope of the standard and see technically what is scoped in and what is scoped out. So the emphasis with customer is that there might be contract. So I'll give you another example. Like for example, you look at financial instruments, Ind AS 32, Ind AS 109. That's again a contract. That's again a contract, but then it is a specific contract which is between two parties. One is called a issuer and one is called a holder. So since there are many standards where the contracts will fall under the purview of either 116 or 109 or 115, you need to be careful to see that we are looking at a contract with a customer one. And we need to read it with reference to the scope of the standard, whether it is scoped in or it is scoped out. So I think that is one of the reasons why they've used the word with the customer in the name of the standard itself. Because if I say revenue arising from contract, which contract? Is it with the issuer and holder? Is it with the supplier customer or is it with whom? I guess that
Yes, sir,
answers
I
your
agree.
question.
So it goes with the contract and not with specific. So I got you. Because
Yes,
there are more than one different type of contracts.
correct, correct. So
Uh,
financial instruments being one and lease contracts being other. So many contracts will fall under the purview of different standards depending upon the facts and
yes,
circumstance of the
yes.
case. Yes.
Another question, sir.
Yeah, please.
Sir, in case of variable consideration, the particular, if there is a chances of variable consideration, it is to be included in particular year or respective years.
Hmm.
Now, it is not going against the principle of conservatism because there are, I mean, it's not, I mean, confirmed that it is going to be there.
Hmm.
It's a
Okay.
basic account principle of conservatism.
Okay. I got your point. Okay. Let me explain this further. You see, when you're looking at the concept of variable consideration, I know what you're coming on the thought process is that this is something which I may or may not receive. And that is for the reason the standard is asking you to make an assessment. That is one. And this assessment is based on a very important principle. And that important principle is that it should not result in significant reversal of revenue. I'll give you a very extreme example just to understand the concept, how companies could manipulate this and why the intention of the standard setter is be to put this clause. Let's imagine my IPO is about to come. I know that if my IPO is about to come, I am looking at ways and means of enhancing my revenues and profits. So what I do intentionally, I'm looking at a very extreme case. I introduce the variable consideration as a part of my TP in every contract. So what I do, I go to the customers and I'll tell them, boss, let's do one thing. Let's include a variable consideration in the TP. The customer will say, sir, I don't want any variable consideration in TP. I said, don't worry. The conditions will never get met. I just want to consider the variable consideration to inflate my TP, the conditions of this variable consideration will never ever get met. So in conniving with my customers, I intentionally create a variable consideration as a part of my TP. So what happens? My TP would increase. I would intentionally make a wrong assessment and say that yes, I will receive the TP, though I'm very sure I will not receive it. So what happens if your TP increases, it would increase the revenue recognition as well. I'm coming to the same point which you're saying against conservative prudence. You see, the intention is that you are inflating TP, inflating the revenue recognition based on the variable consideration as a part of the TP. So what will happen tomorrow when you do a reassessment, you will say, no, 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 my assessment went wrong. And since my investment went wrong, so what will I do? I will reverse the revenue which I've already recognized in the past. So this would mean that your assessment was wrong. So now coming to the point of conservatism. So can I say by introducing this clause as a part of variable consideration, am I keeping the sanctity of conservatism and prudence into account? I'm telling the entity that your assessment has to be not biased. You need to be very careful in your assessment. Please ensure that your assessment doesn't go wrong. So if the assessment doesn't go wrong, can I say I am still keeping the sanctity of conservatism and prudence into account?
Yes, agreed.
Yes, great.
Now, with respect to
Yeah,
hello, Raj, just a
yeah,
question. Hello.
yeah, please go ahead.
Sir, what is the significant? I mean, is by percentage or significant reversal? I mean, how do we decide whether it's a significant, whether it's a 50, 51%? How? I mean,
Okay. Well, there is no guidance which is given in the standard that gives you a cutoff factor, what is significant and what is not. But I would say significant will be decided with reference to materiality. And materiality again is dependent upon organizations to organizations. So there is no fixed cutoff factor which we can attribute. I think it is open to judgment, facts of the case. But I think that significant levels would be materiality based for sure.
okay. So, sir, let Raj complete his question. Then I will raise my.
Okay. Yes, Raj. हाँ जी बेटा. हाँ जी बेटा Raj, please go ahead.
Yeah. So I was asking that customer option for additional goods and service. When it is material right and when it is market offer, is there any litmus test for it?
Can you come again? I couldn't hear you properly.
So my question is the customer option for additional goods and service. When we define it as a right of material or a marketing offer, how to differentiate between them and what is their treatment?
Is this with reference to modification?
No, with this reference that's the customer option for additional goods and service.
Okay. Okay. So your question is that if he goes in for additional goods and services, what is the further point on that?
The when we can terminate it as a right of material or as a marketing offer. When to treat it as a right of material or as marketing offer.
Okay. What I'm able to guess from the point is that you're looking at that I have given the customer options to exercise additional goods and services. Okay, let me explain. You're looking at the material concept, right? When is it material or not, right? If I got the question correct? Raj, I think the material is the main issue, I guess. I'll give you an example. I'm just carrying one of the examples which is there in the study as well. I'll just give you a note of that. Just give me a second. Okay, I may be not able to locate that. I'll just give you directly. Let's say, for example, I told the customer that if you buy goods from me today, I will give you a discount on the second purchase, which is 25%. And suddenly in the market, what I do, I introduce a discount to the extent of 10% to every customer, whether he has purchased goods initially from me or not. So when the customer bought goods from me, I told him that, okay, I'll give you a 25% discount on the second purchase. And immediately after that, I'm giving discount of 10% to everybody. Now, which means this fellow is getting 15% extra discount as compared to the general offer, which is given to every customer. So I would say it is material. Now, here again, you would come to the point, how do you decide that 15% is material? Let's say this difference narrows down to 5%. Would that be material or not? I think that's again very, very subjective indeed. That is the reason that materiality plays a vital role. So you cannot draw any particular line to say, that this is material and this is not material. But I think looking at the percentages, at least from the exam point of view, if you are given any kind of variations, I think it will be a larger variations. And I think I would always consider it to be material unless mentioned otherwise. So from the examination point of view, you may not get worried on the materiality aspect in terms of those additional goods and services. Does that answer your question, Raj?
So can you a bit briefly explain what would be treatment of it?
Okay, treatment in the sense, okay, I'm just trying to locate a question which is there in the study mat. Just give me a second then. I'll tell you the question.
Yeah, illustration 23.
Yeah, I have just actually opened something else where my questions are there. So I think I'm opening the same illustration. Just give me a second. Is this the example we're looking at? Entity enters into contract for sale of 8,000. Is that the question, right?
Yes, same.
Okay. So I'll just give you the facts briefly. Now it says entity enters into a contract for sale of A for 1,000. And as a part of the contract, the entity gives the customer 40% discount voucher for any future purchases up to 1,000 in the next 30 days. The entity intends to offer a 10% discount on all the sales during next 30 days as a part of the seasonal promotion. And the discount of 10% cannot be used in addition to the 40% discount voucher. Now it says entity believes that there is an 80% likelihood that customer will redeem the voucher on an average. A customer will purchase 500 additional products. How many performance obligation does the entity have? And their standalone prices and the transaction price. So I'm just trying to read further what is stated out here. Now, you would agree one thing. I'm given the customer a 40% discount. And now I'm planning to give a 10% discount to every customer. So do you think this 30% extra discount given is material, immaterial? Let me put that to you.
It's material, 30%.
Yes, 30% is quite material in nature. So it says since all customers will get a 10% discount in the next 30 days, only additional discount that provides the customer the material right is incremental discount. So we can say this definitely gives you the right to purchase additional goods and services, which is material in nature. So what I will do, the incremental discount will be treated as a separate performance obligation under step number 2. So when you're identifying the performance obligation, then I would treat this incremental discount of 30% as a separate PO. So a part of my TP will get allocated to this additional discount as well. You want me to explain the mathematical breakup also, or is that good?
So I got the point. The question is, there is one big practical of loyalty points and all this. Similar type of question is there, which was in RTP or somewhere. I had someone.
I know, but that is different. The award points is different from this one. I think if you're looking at that award point question, it was there in RTP a long time back, but that is different from this one. That is you're creating a liability for customer loyalty program, because I know that the customer will be able to avail these award points later. So the concept is same, but the accounting treatment is slightly different from that.
Okay. So yeah, I'm good with the calculation. There's no issue in that. I was more concerned about that. If it is the basis for that question, I would more be clear on this part.
Okay, you mean to say that how do you connect that award point question with this kind of a concept, right?
Yeah, that was because the award points are totally different type of thing, and this was a bit different.
Okay, I would say the concept is again the same, even in that case of award points. Now, I think if I just quickly try to recall that, what we were doing in that case is we are putting the entry bank account debit, and we were booking a sales revenue, and we were booking a liability towards customer loyalty program. So we were attributing a part of the consideration received towards the customer loyalty program. So the concept is same, that you're indirectly treating this as a separate performance obligation, but the calculations are slightly different. But if you say the concept, yes, it is largely the same. There's no difference between that award points question and this additional goods and service question.
So I will look it into one. The concept is same. The only calculation I have to re-go once again so that I be clear on it.
Yes, yes. Look at that bigger question which came in the RTP. I think I recall it's a big question which came in the RTP. I think it's almost a half page size. Yes.
Yes, I don't have. Fine.
Yes, I think Abrikesh, yes, you can go ahead again.
Yes, sir. Clause of escalation is a variable consideration, particularly with respect to, big contracts, construction and or machinery contracts.
Loss of escalation, or you mean to say that compensation or escalation receipt?
No, it's an escalation cost. See, because of the time period, there will be a increase in a price, generally increase in the price of material, raw materials, labor and everything. So there is a clause of escalation. Generally, it is there. So is it a variable or it's a regular TP?
Okay, you mean to say that if I'm getting an escalation claim, do I consider that as a variable consideration with TP? That's what
I'm asking with respect to entity. Because entity is going to collect escalation price from the customer.
Correct. Now, I don't know whether it'll be technically right to say whether it's a variable consideration or not, because it is not something, if I say that something you may receive or not, it's a part of the contract. I don't know whether to call it as a variable consideration, but yes, it would be a part of TP or not, would all depend upon whether the escalation claims are probable or not. So once you reach a particular point of time where you know that the escalation claims are claimable, it would become a part of the transaction price for sure. But whether I will be able to call it as a variable consideration or not, I'm a little skeptical on that. Because this is an amount which, of course, may or may not be received, is again based on ifs and buts, whether the contract gets delayed or not. I have not read any literature which very clearly says that it's a variable consideration, neither any guidance in the standard which says it's a variable consideration. So I would not point blank call it as a variable consideration, but at the same time, the assessment whether it will be taken as a part of TP or not, the same considerations would equally applicable apply. Yes.
How redevelopment contracts are treated with respect to this standard? Generally, currently, now there is a trend of redevelopment. Housing, generally, housing projects.
No, I didn't get the picture. You're talking of redevelopment with reference to what? Variable consideration?
No. With respect to this standard, how these projects are treated with respect to 115.
Okay, so you mean to say that you've already done a construction and now you're planning to do some redevelopment. So could I call it as a modification? That's what you're asking?
It's no, I don't know. No, it's an extension to see what happens is in redevelopment. Suppose I am residing in a particular flat and other flats are also there. Now the project developer comes and offers certain consideration that, okay, we will pay so much, we will give you so much housing and rent till the project is completed. Now this is a redevelopment contract. Now how this is being treated, what is the treatment for such contracts in this standard, 115,
Well, I don't think so. That kind of issue would actually get covered under 115, because if you're paying them compensation, in terms of...
It's a price also, For example, I have 5,700 square yard plot. I mean,
Got your
I
point.
mean, now the developer comes. Okay, we will demolish the society. We will construct the flat. We will provide you based on the what area you are covering currently, flat for that, and also we will pay you certain amount also as a consideration, and also pay the rent of the where we relocate you. I mean, so how these are being treated, because these are actually is a part of consideration only.
Yes, I would say this more becomes like a consideration payable to the customer. So let me understand the transaction. Like it's you're talking of that I'm going to, do a construction for a customer, but for the time being, what I'm going to do, I'm going to take the customer, put him in another flat, and give him some consideration also. So it's like a consideration which is becoming payable from my side to the customer, right?
Okay.
So I think I would consider that as a part of my TP calculations itself. Because on one hand, I am basically getting a consideration to do the work, but then I'm also paying some amount to the customer to get the deal stuck. So in this particular case, if I am not going to get anything as a distinct goods and services from the client, it is indirectly a reduction in my TP.
Okay. Uh, so what are the other examples for non-cash consideration other than equity shares?
It could be anything. It could be, let's say, for example, a material supply, a labor supply by the customer.
Okay.
So it could be any form of consideration. I just took equity shares because I wanted to explain the fair value change. Otherwise, it can be any form.
With respect to significant financial components, sir,
Hmm.
where exception is that it's a trust issue.
Correct.
Now, sir, actually, system of advance is, I mean, between the lines, a trust issue. And
Hmm.
particularly when you are, I mean, when we are dealing with the entity and the customer,
Hmm.
trust issue is always with the entity from the customer.
Not
So
always.
how can it be exception? Matlab, because, I mean, see, it's the terms of contract, but after
Hmm.
all, I mean, it is a trust issue only because entity has a doubt that the customer will run away or not.
No, not really, not always. I'll tell you. For example, I've got 10 customers and I've got an industry practices that I always take in advance. Now, if I've got an industry practice of always taking advance, it may not be, apparently you might say it's a trust issue in that case. But, if I'm in the habit of taking advances always, or let's take another example that I've got 10 customers and two people have taken advance, rest I don't take an advance.
Okay.
Now, the two people from whom I took the advances because of their financial backgrounds, because I have trust issue. So I think when you're looking into the fact whether they are trust issues or not, you'll have to look into the entire set of contracts the company has. You can't really say that advance would always be a trust issue or delayed payments will always be a trust issue. You'll have to look into the comparative contracts with the other customers. So how do you behave with the other customers in general? So if I don't take advances from everybody, but these two people exceptionally I'm taking an advance, then I think the trust issue, definitely
Got
comes
it.
into.
Okay. Thank you, sir. That's all from my.
Yeah, yeah.
So I was asking one question like that in
Ajit.
non-cash consideration, the form of consideration. So the only thing fair value will be changed for price of equity share, not for quantity of or number of equity share. If the number
Correct.
of equity share changes, we have to address it or make an adjustment for it.
Yes, yes. Then that, you see, the number is a variable consideration. So that would be
Number
taken as a part of the TP calculations.
Okay, so the form of consideration with respect to only price need to be considered, matlab, need not to be considered. Only price, or is there something else as well?
No, no, no. So basically what we're trying to say is that there are two elements. One is you're looking at the number changing and one is you're looking at the value changing. So if there is a change in value, it's not a part of 115. Then it's a part of 109. But if it is a number change, it's a variable consideration and that would be a part of TP.
No, is there any other example of form of consideration other than
Yeah.
equity?
Yeah, as I said, there could be material, there could be labor. I think what I think Abarish was asking. Yeah, so
Correct.
there could be material. Like for example, if I'm looking at a contract, the customer says that I will supply the bricks, I will supply the labor force. So indirectly, he is giving me a consideration in the form of material. So material, labor, supply. But in case of material and labor supply, the value would not play a role. And neither I think the quantum will play a role. So I would only consider, because there will not be any fair value changes to the, the material and labor. So my intention of taking equity share was only to give you the picture that there could be change in number and value. But in terms of bricks, in terms of material labor, I don't see these factors would play.
Okay.
Okay, I think we've got Viraj also. You've got any questions?
No, sir.
Okay. Okay. Any further questions coming to your mind? Anybody else?
So I was thinking that repurchase option, there was repurchase agreement, forward, call, and put. Can you elaborate it a bit?
Okay.
Like,
Okay, that's a little longer picture actually. So you'll have to maybe look at the videos back for that, because that's a long down exercise. Because when you're looking at, I'll just give you a very basic brief on that.
yeah.
There are basically two kinds of situations. One is a case that there is a sale and a repurchase. So you need to see whether it's a case of forward contract or is it a case of option contract. And along with this, whether it's a long call or is it a short put. And accordingly, the treatments will follow. So I think that's a very long exercise. I may not be able to give you the entire details. It'll take me at least half an hour to do that. So maybe I can request you to have a look at the video, which was there in the previous sessions, because that's a long permutation combinations of you need to compare the selling price, the repurchase price, and all those things. So you'll have to make a reference to the video in that case, I guess.
I have watched your all the videos. It's fun watching that.
Okay, that's great. So did you get the combinations of all those permutations and all in
Yeah, I have
repurchase?
made all the things what you have written. I'm just recalling it back for a put option. Can you just say me that when the when the for put option, what are the process like when the repurchase price is greater than the original price and that all?
Okay, I'll see if I have a chart in front of me. I'll just like to quickly give you the chart. I'm just trying to keep some charts handy with me, which I generally use in my class. Let me see if I can locate the chart, then I'll just quickly give you the inputs. Okay, so basically you want me to give you a little inputs on the option part, right?
Yeah, put option.
Okay, I'll just quickly give you some inputs. Maybe you can copy this chart. So what we're going to do in this particular case is you compare the repurchase price versus the original selling price. I'm putting short forms. And
Yes.
in this particular case, there will be two permutations, combinations. One, we'll have a situation where the repurchase price is less, and the other one where it is greater. Now, if it is equal to or greater, this is one case. Now, in this particular case, now what we need to do, we need to compare in this case, we will compare the RP that is supposed to be I'll compare the repurchase price versus the expected market value. In this case, I'll make that comparison. And if it is less, then in this particular case, we'll have to look into does the customer have significant economic incentive? The customer have a significant economic incentive to exercise the right.
So when the market value is greater than the repurchase price,
Yeah.
so it is deemed that they have an economic incentive to not exercise the option.
When the repurchase price is greater.
Yeah,
Yes.
when the market value is greater than repurchase price, so there is no economic incentive.
Correct.
When the reverse case is there, they have economic incentive.
Yes, so that's what I'm about to put out here.
Okay.
So if I just quickly put that input out here, then in this case, we can say if the repurchase price will exceed the expected market value, I would say they get a incentive. So the incentive is there, yes. And if the incentive is there, we are going to apply Ind AS 116. It'll be a lease. And if it is the other way around, that means repurchase price is less than the expected market value. We would say no, there is no economic incentive. And in this case, it is treated as sale with the right to return. This is, in short, very brief, the inputs which you wanted, very short chart. Does it help?
Yeah, actually, you didn't cover it, na, that day. The topics were not.
Okay. So I think I've covered that today.
Yeah, yeah.
Sometimes we do feel a little constraint of time. In fact, one class also becomes a little less at times to, cover up such a big topic like Ind AS 115. So many things. I have not touched upon the special issues related to Ind AS 115, but you can understand the time constraint. So due to which, I've just tried to give you the crux of the standard in just, 3 hours time.
So the other limb, when the repurchase price is greater than the original sale price, so it's a financial agreement.
Yes, financing. Yes.
Okay, so okay, fine. No, actually, I have read and made my own chart, but your charts are typically very clear.
Thank you for that. Yeah. Any further questions?
No, sir.
Okay. If both are done, Raj, any questions? Abrakesh, any questions?
So there is one question in module of a variable consideration where the calculation is done, but the sum total is not matching due to round off. But whether we can directly calculate by subtracting rather than calculating what they have done. There's one big question for variable consideration. Let me tell you.
Running in a couple of years, I guess, 3-4 years. Is that the question?
Yeah, bonus is also there. Then the reversal. Then let
No,
me.
but I think the calculations are correct. To my mind, I don't see any challenge in the calculations.
No, there is no challenge. But when I was calculating, I got the answer. But when I checked with the module, it was not matching. Then I
Could be a
recognize that
little
there is a
confusing.
rounding of error in the module, that the sum total is not matching.
I didn't check that actually, if the sum total is matching or not. But I guess the answer is correct. But I remember there is a big question for 3-4 years. It is running.
Illustration 32. Yeah.
Yeah, and then there is a lot of percentage and all. I frankly, I didn't check whether the totals are matching or not. But I think largely the question is correct, I guess.
Yeah, because of round off, the total is not matching.
Okay, that could be there. That could be there.
But the difference is of 1,000 around. So I was thinking why my answer is not matching.
Okay, I didn't check that. Right, so I think that seems to be good for the day. So I think now I'll take leave from you. So it was wonderful interacting with all of you. So see you next week. We'll have some more sessions coming on financial instruments, consolidation and all. So I'm trying to give you some more tips, concepts in the coming class as well. So thank you all of you. Bye-bye and take care.
Thank you, sir.
Thank you.
Thank you, Ashok.
Thank you, sir.
Thank you so much. Thank you.
So you wait,